Setting up an irrevocable life insurance trust, or ILIT as it is sometimes called, is a fairly popular strategy for avoiding estate and gift taxes. Generally speaking, all life insurance payouts benefit from being free of income tax, but without an ILIT, that same life insurance will increase the total value of a person's estate for estate tax purposes. What that means is that without an ILIT, part of the insurance that is paid out to your beneficiaries might be subject to estate taxes. In fact, it's entirely possible that around half of that insurance will be eaten up by estate tax. ILITs have the ability to prevent these taxes from being levied in the first place, and that is precisely why people set them up. Let's take a closer look. So while life insurance makes sense in many circumstances, clients often ask why they would want to house that insurance in an irrevocable trust. This is best understood with an example. For simplicity's sake, let's assume that the estate tax exemption in effect at the date of a person's death is $1 million, and that person dies with exactly $1 million in his or her estate. Plus, they have an insurance policy that will pay out an additional $500,000. Because his or her total estate equals $1.5 million in this example, an estate tax will be owed on the additional $500,000 above and beyond this person's exemption amount. Since estate taxes can be brutal, one can expect to pay hundreds of thousands of dollars in tax in this situation. Now, if an ILIT were properly set up and life insurance was purchased and housed in it, there would be no estate taxes owed, because at the date of that same person's death, only $1 million would be in his or her estate for estate tax purposes. The other $500,000 from the insurance is in the ILIT. The net result is that the beneficiaries of this estate would wind up with the entire $1.5 million free from estate taxes. Definitely a better way to go. There are other matters to be careful with when setting up an ILIT though. For example, if you transfer existing policies to your ILIT as opposed to new policies being purchased in the ILIT, you must live at least 3 more years, or else the proceeds will be pulled back into your estate. This is where things can become a bit sticky, and you should definitely discuss this further with an experienced estate planning attorney. Please see the next video to learn more about how an ILIT works from a procedural perspective.